The ripple effect of energy retailers quitting the open electricity market could be set to grow. More than 100,000 households have had their retailers iSwitch and Ohm Energy exit the market, and uncertainty remains over several other firms that don't seem to be taking on new contracts. Industry watchers have questioned where all of these leave Singapore's liberalised electricity market. For more, we have Chong Zhi Xin, Director of Climate and Sustainability at IHS Markit. Now, Zhi Xin, first, some quick context. Electricity retailers typically charge cheaper rates than SP Group. So how do they do this, and how does this leave them vulnerable?
Yes, that's right. So if you look at electricity retailers, they tend to be able to charge cheaper prices because they would purchase from the wholesale electricity market and sell it to end users on fixed tariff basis or at a discount to the regulated tariffs. So that's how they do their business model. Unfortunately, that exposes them to the market fluctuations like we're seeing today.
So, yeah, this is also not the first time that we've seen a retailer exit the market. Red Dot Power did so shortly after the OEM was launched about 3 years ago. So was that a warning sign?
Well, that was really a one-off event. I think the situation that you saw of Red Dot was they had a very uncertain business model. They weren't able to really coalesce and obtain enough market share to be financially viable. And that is why they had exited the market back in 2019. But if you look at the situation today, it's really different. We are seeing a number of retailers actually encountering financial difficulty. And it's really because of the spike in the wholesale electricity prices, which is leading to a very unsustainable situation that has resulted in this wave of companies actually exiting the market.
Yeah, but oil and gas market fluctuations, they're not new. So is that the only factor this time, or what's different?
Well, you are right. I mean, if you look at the oil and gas market, we have always seen fluctuations, but the situation today has been quite different. I think if you look at the same time last year, oil prices were only going at $40 per barrel. If you look at the prices today, it's more than $80, and prices have been on an upward trend. But compounding that situation, it's not just the oil market that's experiencing a shortage. You're seeing shortages in coal, you're seeing shortages in oil as well, you're seeing shortages in power. So there is a wave of crisis that's really rippling through the energy value chain that's really affecting a number of players. And Singapore, as we are importing a lot of our pipe gas and LNG from markets overseas, we are vulnerable to these price shocks as well. And unfortunately, this has led to a number of events and a number of companies actually exiting the market.
And so where does the OEM go from here?
Well, I think if you look at the OEM market, there will definitely be waves of consolidation. And that's just in response to the high energy prices that we see today. But competitive markets allow a lot more competition. It allows a lot more players to come in and exit the market. So this sort of market consolidation is something that's quite natural that occurs. So when we're looking ahead, it's really about understanding how long will high prices will be likely to last. Now, we do think that looking ahead into 2022, 2023, it does look like gas prices will continue to stay high. And unfortunately, that will cause a little bit more pain, especially for end consumers as well. So this consolidation is likely to continue for some time.
Well, thanks for that. That was Chong Zhi Xin. He's Director, Climate and Sustainability at IHS Markit.